Friends, in this video for I Thought Wealth, I'm going to talk to you on the topic FMCG, are we heading for a shock? Probably this is not the best time to question FMCG. Just a day or two ago, we saw a key management person shift from HUL to Godrej Consumer and the stock went up 21%. So, when we see this kind of a gung-ho behavior, questioning FMCG can be quite treacherous. But from experience, we've seen that the same behavioral pattern or the same circumstances don't repeat, and they definitely don't repeat too soon. They repeat after a very long time. Last year, when we had the first bout of COVID, FMCG turned out to be a massive beneficiary. People bought everything they could. They filled their homes with food. They filled their homes with things which they usually don't buy, and they bought more than they usually did. Consumption happened at a pace which was unprecedented. Now, when we are having the second wave of COVID, we are seeing a completely different pattern. I was watching a TV program in which the chairman of managing director of Amul was saying that consumption is actually taking a hit. Probably something which the listed company chiefs would never say so openly. But coming from somebody who sells a very, very essential product, something which we buy, and a product which has got a huge bearing on consumption behavior, this cannot be overlooked. Another factor which most investors have completely lost memory of or lost count of is that FMCG companies have been experiencing falling inflation for a very long period. It's almost a decade. Today, they are facing rising inflation after such a long period. And the benefit of falling inflation was clearly with the companies. The companies really did not need to pass on the benefits. But now, with rising inflation, companies would need to pass on these benefits or absorb the effect. Either ways, this will impact the kind of shareholder value these companies can create. So, in an inflationary period, one will see FMCG companies coming under tremendous pressure. Pricing power is not what we believe it is. Generally, we have been thinking that there would be no pricing power problems, that there would be no issues with increasing prices. But that is not the history. We have seen phases where FMCG companies struggled with pricing power when costs went up, and they wanted their demand to grow, and therefore they had to make some compromises on the pricing power. We are probably heading into a phase when demand will test pricing power of a number of FMCG products and at an aggregate level of a number of companies. Generally, companies which have a weaker position will be tested very badly, and companies which are stronger position will be tested relatively lesser. But either ways, it's going to be a phase where headwinds will clearly strike FMCG companies. They will struggle to meet investor expectations, and while they enter this difficult phase, investors are completely oblivious of the challenges which these companies are going to face. The recency bias of what happened in FMCG companies over the last 2 years dominates our thinking, and we are simply not willing to take cognizance of inflation headwinds and what kind of a damage it could do to our expectations. The problem lies not with the companies. The problem lies with our expectations, because we have priced in so much of expectation that those expectations are not going to be met and we are going to face disappointments. When we face that disappointments, it is likely that investors will decide to reduce their positivity on FMCG or reduce their valuation expectations of these companies. We are probably most likely moving towards such a phase. So, that is something which as an investor we must take cognizance of and not be overconfident. This is not something which investors who have joined the market in recent years are even familiar with. This is something which the new investors must familiarize themselves with and factor into your expectations. While you will continue to consume the products you do, you will continue to buy products which are essentials, you will still become more careful with your money, you will consume a little less, or you will downtrade buying second rung brands over first rung brands, or you may actually change your consumption pattern so that your wallet is still protected. So, we are moving towards such a phase between 2020 and 2021. We are going to see this dramatic shift in behavior of consumers from buying everything you could lay your hands on. Now, you are going to reduce your visits to the shop. That is a very big shift, and you are going to reduce what you buy, the frequency of buying of even products which you really like. That is essentially not usual, it is extremely unusual, but we live in unusual times and it is good to take cognizance of that. If you like this video, do share it with your friends who are keen investors in FMCG companies, students of investing and active participants in the stock market. Do stay with us on this journey, become a part of this community. Thank you for watching this video.